welcome to the Weekly Market View. I'm here with Bill. So this week we've had quite a busy couple of days. We had Bernanke's testimony yesterday, sort of kicking things off in the afternoon. What did you make of what he was saying, and how do you feel about his tapering?
He said what I was expecting, and I was quite surprised, shocked, whatever term you want to use, on the market reaction, because one of the things that we had to look at was the day before we had two Fed governors who basically had been inferring 2 or 3 weeks ago, that we could see tapering begin next month at the June FOMC meeting. But even on their comments on Tuesday, they were basically saying that the economy is slowly recovering. Inflation is not a problem whatsoever. And remember, yesterday's comments, initially, it was just a prepared speech, which he read. Then it was the Q&A. And again, I think it was a situation where he sort of inferred, we will make whatever changes needed to be made, okay? Now, if there's going to be the changes, I think we're talking about maybe reducing the mortgage-backed security purchases. But I didn't see anything that didn't say we'll keep interest rates lower for longer. And, we're still well away from that 6.5%. And the concern about inflation, what inflation?
Yeah, no, exactly. I think it may, have been a slight overreaction, because he did actually say that they could look to raise purchases if the data was bad.
And I think one of the things, again, I'm a sick dude. I was reading the Congressional Budget Office. Their implications, because receipts are coming better in, taxes are coming in, and the Treasury over the next 12 months probably would reduce their issuance by $200 billion. Well, that's $200 billion that's not going to come into the marketplace. So forget what the Fed does,
Yeah. Also, touching on the QE, and if he does start to taper whenever it is, what do you see as the effect sort of in the wider markets, like in the emerging economies, for example?
Well, I think, as you just said, forget the Eurozone and the UK. This is where the problem's going to be, because what we have seen with historically, unbelievably low interest rates, with whether it be the BRICS, whether it be, whatever anagram you want to say, so many of the, especially Asian countries, Thailand, Vietnam, Iraq, and even Russia, Poland, they're anywhere from like 60 to anywhere from 35 to 60% of their GDP has been on borrowing. Now, if interest rates start to go up, this could have a negative effect. And I know it's gone from whispers to, I think there was a comment in the paper today saying, could we see a reenactment of what we had was the Latin American crisis in the middle 80s? No, I don't see that, okay, where the world had to bail out Argentina and Brazil. I don't see that, but I do think that this is where the concern will be, is when interest rates start to go up. Last man in is going to be the first one that's hit.
Yeah. Do you think we've seen quite a large sell-off in the stocks over, these comments from Bernanke, and also on the back of the Chinese PMI data came quite weak? Do you think that this was like the start of the bursting of the stock bubble, or do you think that do you think this has been coming, or do you think it's just a temporary sort of
I think, had we had this conversation, when you talk to any analyst the first week of January, whatever levels they were talking about, whether it be the FTSE, the DAX, the Nikkei, the CAC 40, any of the Wall Street indices, we beat those kind of levels by like the first week in March. So we were, quote, if you will, and this is probably the wrong term, living on borrowed time. The simple fact is, by midday yesterday, I think we were within 30 points of the all-time high for the FTSE, right? This goes back years ago. So if you want my honest opinion, I think this is, quote, a healthy reaction, because I'm sure there are loads of people out there that said, well, I should have bought such and such in February, I should have bought in March. Well, now, if we've had this sell-off, and another thing that maybe some of our viewers have to remember, both here in the UK and in the US, Monday is a holiday.
A particular stock which took quite a hit was the Nikkei indices. We saw yesterday morning the monetary policy statement from the government, and there wasn't too much reaction on the back of that. However, after again this Chinese PMI data, we saw quite a bit of volatility there. We were expecting him to voice concerns over the volatility in the bond market, and he didn't. But after the data, yields touched 1%, went through 1%, and so they ended up injecting 2 trillion yen into the economy to sort of subdue the volatility. What do you make of it? Do you think it's nervous markets?
Well, I think so. And let's be honest, okay? Up until yesterday, slight problem. I mean, the Nikkei was up 79% in 6 months. I mean, it had been up 79% in the previous, like, 6 years. So we're seeing a positive follow-through. We're seeing less savings and more spending. And one of the things also to look at is 2 trillion yen. I mean, that's like peanuts. I mean, you know, in the old days when they were really trying to support the currency, I mean, 2 trillion yen would have been like 2 minutes worth. And I mean, we did see the dollar yen trade below 102. Yeah. So it has taken some of the froth off the market. But again, it's a situation where, you know, the Nikkei will come back, so will the FTSE, and so will most all the stock indices, because interest rates are going to stay lower for longer globally. So investors, and I'm talking about pension funds, insurance companies, even individuals now, they're getting nil point return on their money. And it sort of says, like, how did we do in the Eurosong Vision contest? I didn't see it yet. But, you know, so they will continue to go in, and they're starting, you know, that's the only place you're going to get yields from, you know, dividend yielding stocks or you know, price appreciation.
Just to also bring it back to the UK as well, we had the Bank of England minutes on Wednesday, yesterday. We saw King sort of get defeated again.
Sir Murphy.
Yes, Sir Murphy King defeated in the vote for the 4th month. I think we've seen weaker retail sales and also weaker personal consumption data than expected. I think the effect of, we're not really seeing the desired effect of the QE maybe. Why do you think that it's not really
I think in one respect, I think we are seeing the desire, because it's keeping interest rates lower for longer. But I think one of the things that you have to look at from the standpoint is, even with inflation dropping, you're only having average earnings are only going up 0.4%, okay? So one of the things, and this came out from the Mortgage Bankers Association several months ago, was that you had, like, in the last 3 years, you've had multi-billion pounds worth of mortgages being paid down, credit cards being paid down. And again, the Mortgage Bankers Association came out with another one of these worrisome reports about 2 weeks ago, talking about, I think it was like 1.3 million people, okay? And unfortunately, it's not going to be the people in Chelsea Walk or this, that, and the other. It's going to be the real people whose houses are worth 125,000. But they're talking about like 1.3 million who have interest-only mortgages. When they expire in 2015, they will not have the savings to pay off the principal. And, you know, 5 years ago, it made no difference because your house was going up 5–10% a year. And also, they're talking about 2030, it could be over 3.5 million. So I think what we're seeing on a positive standpoint, we're seeing a massive amount of money being used to pay down mortgages and also credit cards to get the debt down.
Okay, brilliant. All right, well, thanks.
Thank
That's
you.
all for this week.